Welcome to our CFA members and guests to another edition of Macro Matters. We are in the post-Easter version here on Monday, April 21st. It's Easter Monday, so a lot of Europe is off, and I think many people are still on the last parts of spring break here for those in the private schools, etc. My name is Rich Excell, and once again, I'm joined by my co-host Tony Zhang from U of I and from the CFA Society of Chicago, and from Blaine Reed, also a member of CFA Society Chicago, who was with us in the last Macro Matters and is back by popular demand. The massive have voted for it. They wanted more Blaine Reed, and so we brought them more Blaine Reed. So welcome to you both, Blaine and Tony. Thanks for joining me.
Yes, Rich and Blaine, so good to see both of you after the Easter. Apparently, over the past couple of weeks since our last episode, I think we have already seen like huge market volatility, and a lot of things have been going on, ranging from the domestically and to international like a development, right? So I am looking forward to discussing with both of you.
Yeah, great to be here again. Thanks for having me, guys, and looking forward to it. A lot to talk about.
Lots to talk about for sure, and I think in order to do so, I'm gonna we're gonna talk through these things if you're listening to us on the podcast. But if you're listening or watching on YouTube, you'll be able to see this. I'm gonna share my screen to bring up some Bloomberg charts that I want to talk about. But this was like the first thing that we were talking about here as we were offline. And Tony, I want to get your thoughts on this to begin with. This is the relative performance of the Chinese stock market. I'm looking at the Shenzhen market there versus the SPX.
Yeah.
And we can see I'm looking at over the last few years or so. If I lengthen this out, this would look like a lot of what a lot of charts look like of the S&P versus the rest of the world, right? Whether that's broader emerging markets or all developed markets, et cetera, where the U.S. had been outperforming for the better part of a decade, if not longer. But ever since last fall, in particular this year, we've seen money flowing out of the U.S. and into other markets. And China is definitely one of the beneficiaries. And so maybe Tony, as our China expert, what do investors seeing in China that they like, and more importantly, what are they maybe not seeing in the U.S. anymore that they used to like?
Yes, Rich, this is actually turned out to be a million dollar question because it does actually involve with lots of institution and central bank globally when we're actually talking about the market relative movement, especially pointing to the Chinese market movement relative to the U.S. Stock market here. And one thing that's certainly for sure that this is mainly a trade war between two countries. Actually continues to heat it up. So whether the situation actually could change is just like within a short amount of time, this is something that we do not know. However, from the investor point of view, definitely investor already take some vote uh, with their own capital. Definitely, the trade war is going to maybe cost um, both sides, including both China and the United States as well. Both sides would actually would cost. It's like whether there will be a transitioning loss, as what President Trump actually already mentioned here in the United States, or could be actually could lead to the long term benefit. This is still quite uncertain, and even though many people might agree this is the trade war for a short amount of time might cost some U.S. consumer and U.S. economy a little bit cost, but over the long term, if the reindustrialization and manufacturing industry can be actually rolled back into the United States, that will actually help to solve the issue of the U.S. Hollowing of industrialization. But talking about the Chinese stock market, apparently we continue to see the money, the capital flow into the Chinese stock market over the past 7 or 9 trading section when the U.S. stock market here continues to tumble, including together with the U.S. dollar and together with the Treasury bond. Now here, apparently, we this is certainly for sure. We see the capital out from the U.S. market, capital market, and when those capital outflow from the U.S. market, especially from the European country, now they have to really ponder where they're going to actually deposit those outflow capital. Apparently, over the short amount of time, they're not going to roll back into the U.S. stock market or U.S. capital market, but they have a couple choice. One is they can continue to invest back into the EU European market, or they can buy gold, or they can buy crypto. And apparently, like one of the most attractive assets, like with the lowest or most attractive valuation of the capital market in the world is China. So that's why we continue to see the capital inflow into the China over the past 7 trading days. This is where we see the relative strength of the Chinese stock and in Chinese stock market, represented by the CSI 300, the largest 300 like stock, the composites within this index. So this is turned out to be a thing from the risk parity perspective. This could be why we saw the relative performance. Yeah, apparently there are a lot of things going on, Rich and Blaine. I
Yeah,
want to.
no, that's a great point, and I think as you say, there's some positive things going on. I think we highlighted earlier this year, when she's president, she met with some of the tech leaders, some of the positive idiosyncratic things going on in China. But if we weren't seeing this across every relationship, then we might think it is actually a Chinese move more so than a U.S. move. But I think the fact that we're seeing the U.S. Assets and U.S. stock market, et cetera, underperform not just China, but emerging markets broadly, developed markets broadly, et
Yeah.
cetera, and seeing that across stocks and across bonds, you might think that there was another market, but I think it's more U.S. centric. And I think that was most apparent to me when I looked at the most recent Bank of America Fund Manager survey, where we saw that global investors have moved out of U.S. assets in maybe the fastest pace that I think Bank of America's survey had shown before, and went from what was a material overweight at the start of the year in a mad dash to kind of get back closer to equal weight, in the U.S. assets. And while if we're talking about just the SPX or the U.S. Treasury markets, those markets, or excuse me, are large enough and deep enough to maybe absorb some of that flow. But I think maybe what starts to happen is some of the other markets start to get impacted as well. And along those lines, I wanted to kind of bring up what Blake, you and I were talking about before, which is the levered loan market. But because it's not just, we can talk about public markets, but maybe we want to speak about private markets broadly speaking, but you were mentioning particularly the levered loan market. So why don't you talk to us about what we're seeing here? Because ultimately, when we start to see some wobbles in the biggest parts of the U.S. Markets, the as we kind of move away from that core, those markets are going to suffer too.
Yeah, no, thanks, Rich. Thanks for this chart as well. Yeah, as we were talking kind of before the podcast, there's been a big move here, as you can see, in really from where we started the year. Leverage loans, I think 97.5 kind of was the average price. We're into I've got them at 95.11. So, a good almost 2.5 point move, 2+ point move just from the beginning of the year on kind of this Liberation Day since then. And we're off the lows a little bit that we experienced in April, but we're still mightily below kind of where we started the year. And I think that's a couple of factors. Obviously, the uncertainty that companies are going to have as we're right now kind of starting the reporting cycle for a lot of these companies, and their not only their earnings outlook, but their capital spend. I think you have a lot of investors that have moved out of the leverage loan space. Outflows last 2 weeks ago were at record levels. Last week was another, I think, $1.5 billion out of the asset class, just generally speaking. And it's call it broadly syndicated loans, or a $1.4 trillion type asset class. So there's been a little bit of an unwind as far as some of the retail funds and ETFs moving away from the asset class, and then you see that reflected in prices. I think too, another thing, it's not reflected here in this chart, but what I've seen in other research is the percentage of loans that get measured that trade above par. Earlier this year, the percent of the market that was trading north of par was over 50%. Today, when you look at that, it's less than 2%, or right at 2%. So there's been a big move in potentially selling assets. This is my view, selling assets that you're still able to sell at or near par. That has probably put pressure on overall price levels in loans. And then, the bottom half of that is your lower rated triple C, B minus type credits have seen a large move down as well. So all that has kind of put pressure on loans. And then maybe to add to that, up until today, there really hasn't been any new issuance in the loan market, with companies bringing deals to market since Liberation Day. Again, kind of reading some research, but that's one of the longest, if not the longest, time periods we've had recently where there's just been no issuance. And I think high yield markets maybe has had a little bit of issuance on the bond side, but I think they've experienced similar where, deal flow is just kind of shut down. So I think all of that is weighed on pricing here, and you can see yields have responded accordingly. So a couple of things to watch, I think, for me would just be see if this continues to hold. Like I said, we bounced off the lows, but if you look at the volatility that we're seeing even today, it really is somewhat day by day.
What one thing I want to a couple things I want to unpack, but first thing I might talk about as you're talking, Blaine, I'm thinking to myself, this is kind of an indicative of market where you don't sell what you have to, you sell what you can, and then
Yeah.
I think when you're talking about things that were trading above par, that definitely jumped out to me. Oftentimes we think, oh, in these times of stress that people are going to sell the things that they like the least, right? The things that get out of the portfolio, the things they like the least, but that's not always possible. So you just sell the most liquid type of stuff, and maybe we've seen that in some of the large cap stuff for sure. But I guess the other thing I would ask, and maybe this is like, to what extent are we seeing liquidity dry up in the markets? Because that would also be a kind of a strong sign of maybe some stress, and ultimately. I think we're starting to realize that if there's a Fed put anywhere in the markets, it's not going to be in the stock market. It's probably going to be in the credit markets, the loan markets, the bond markets, and
Mhm.
trying to understand where we might be seeing some stress that might be highlighted by a lack of liquidity.
Yeah, so knock on wood, there hasn't been too much of that, but at least that I'm hearing. I will say kind of liquidity in the day-to-day loan market. I think two things. Yes, you have crossover buyers who participate in the loan market. So you have bond managers who reflect to positions in the loan market, some hedge funds. So I think that to your earlier point, Rich, about selling what you can, I think a lot of those are going to be the accounts that are probably selling loans that are at par, north of par, versus maybe bonds or an equity position that's taken a larger hit. So, um, but the other part of that are the participants, kind of the average, the everyday participants in the loan market. You've had that exodus from the retail funds. CLO issuance is still there. There are still CLOs that are getting printed, but even there, the bid from investors, as you see loan markets back up on a day-to-day basis, maybe that bid is thinned out a little bit. So it's not as maybe robust as when we were talking a couple of weeks ago. It sounded like to me that those buyers were kind of ready and willing to step in, loans back up a quarter point. I want to start buying. Maybe that bid isn't as robust right now, as more managers are apt to sit on a little bit of cash. So I think, so liquidity still seems to be relatively orderly. But I think it is something we should certainly watch.
Tony, I
Yes.
want to get your thoughts on, because I think last time when we met, you maybe were a little bit more bullish than I was about the markets, and we got a really nice bounce in the markets. And so I'm wondering, are you still feeling that maybe are a little bit overdone, or what are your latest thoughts on the riskier parts of the market now?
Yes, Rich and Blaine, thank you for you guys like a comment and providing the insights about the liquidity over the bond market here. Liquidity definitely is one of the major issue for financial market right now. And any movement, just as what we have saw over the past 2 to 3 weeks, and even though now on, actually remind me of thinking about either the time in pandemic in year 2020, and also during the time in great financial crisis. And I think the certain will be somewhere around 2011 when we actually saw the Greek debt crisis. That's when the moment that we saw the liquidity actually driving up over the market, causing the investor to sell the most liquid asset first rather than the non-liquid asset. So this is more of a people who already investigate this liquidity premium event heavily since like a past three crisis, and this is definitely what's going to happen is people are going to sell the liquid asset first. This is what we are seeing today. And the next step was are going to actually sell off the non or illiquid assets. So this, I think, many of the both institutions, either they already own or they haven't owned. This is some kind of event that they are waiting for. So what that really means, if we actually look at what the report about the Harvard and Yale's endowments over the weekend, and apparently Harvard endowment own like pretty much more than 40% of their investment into the private equity and VC, which are actually more of illiquid assets, and similar as the Yale endowment. So when we actually saw this kind of a two largest like a university endowment facing the similar issue, you can actually have a sense about other institutions in the financial market at this moment. So if what's going to happen is once we actually move to the stage two at this moment, so we might continue to see some orderly liquidity, but it's very likely if the situation did not get better from here, we might actually see the file sale of illiquid asset due to multiple strategies. For instance, like the risk parity strategy, right? Once we actually see the high volatility over the market, and then you have either bond and then you have equity on both sides, then you are going to sell off on equity first. And then once we actually see the volatility in the bond market, in the long market here, then you're going to see the fixed income side would actually got sell off. I think this is institutional investors and are waiting for the second stage of this event development. Whether the second stage will come, and coming back to your question, Rich, when or whether Federal Reserve will actually step in and executing the Fed puts into the treasury market is, I think, people need to wait for clarification. But if we actually look at what Chairman Powell, the comments last week in Chicago, okay, he was here in Chicago, talking about the Fed's policy with regarding to the recent development about the tariff by current administration. We definitely do not hear, I think from institution point of view, we do not hear what other people want to see is that Federal Reserve is waiting, it actually is ready to do the preemptive cut as demanded by President Trump. So this Fed put would come in or when, this is actually might be people are waiting. So that's, I think the current situation is no one is willing to take a more of a risky bet at this moment, and no one is actually ready to sell off what they currently hold. We might see some kind of battling here, but if we look at something that what we continue to watch from the quant perspective, looking at the volatility index VIX actually stay at above 30, 34 right now. So this is level of volatility, and now given it has been staying here for so long, it could, to a certain extent, it could trigger the second stage of the avalanche. So that might be pulling back from what I already mentioned about. We might actually see the development into the avalanche effect in the financial market if things does not move correctly, because Federal Reserve hasn't really get ready for preemptive cut. That's my take so far. What do you think, Blaine?
Yeah, well, it's fair. I still, I guess I'm still of the opinion that I don't think rate cuts matter. They're not going to matter because it's not going to if the markets are seizing up because people are uncertain, 25, 50, 100 basis points isn't going to necessarily matter. There has been some talk about whether or not the Fed will do quantitative easing as a way to kind of maybe
Yes.
help soften these flows. I want to highlight here something that someone had sent to me. They're just kind of showing that we talk a lot about public markets, but private markets have been obviously the one of the drivers of the cycle here the last several years, right? We've seen assets we've seen asset owners wanting to move assets into private markets. We've seen a lot of people in our own society moving into private markets from public markets. So you've seen money, you've seen capital, you've seen a lot of returns chasing into private markets. And this is a chart of just the it's a ETF of the different private equity firms, and I'm showing this versus the broader financials index, and just showing that there's been some pretty steep underperformance this year, particularly if we look at it like a lot of things in the second quarter of this year, starting really the first week of April. It's been when there's a meaningful underperformance, and I know that there's been some, so there was a chart that I came across. I think I don't know if it was the FT or Wall Street Journal, but they talked about how private equity firms are sitting on a record number of companies that they want to sell. And then kind of going back or tying in maybe some of the thoughts that Blaine had on the loan market. I noticed that in its earnings, JP Morgan mentioned that they pre-provision for hits to their loan book. And they typically we changed I think the regulations several years ago where now you pre-provision only when you have to have the expectation of loss here, and it seems like private credit is potentially going to become more and more into the focus because private loans and private credit are underpinning all of this private equity, and private equity funds may be struggling to find some liquidity to get out of some of the companies that they want to sell. And is that really going to be where we see the potential crisis here? Not so much in the public markets, but in the private markets, because that has really been um, arguably where a lot of the money has gone the last several years in the post pandemic world. I don't know. Kind of going back to you, Blaine. I
Mhm.
know you're talking about the loans before, but how might we think about trying, thinking of the extension of that to the private credit markets and then the private equity markets, and where we might find risk factors that are not as transparent because we don't see them flashing on our screens every day?
Yeah, I think we'll start with the private equity side first. I think coming into the year, the expectations were that because you were hearing a lot about that, what you just mentioned at the end of last year about private equity sitting on a lot of deals they needed to sell, pay back their investors and their funds. And coming into the year, the idea that there was going to be deregulation, better tax policy, some things that were going to unlock maybe the M&A type, LBO type transaction, calendar, and we just haven't seen it. And then you layer on top of everything that's been going on with the tariff policy. It would seem to me that there's just again, I hate to keep using that word uncertainty, just a lot of uncertainty about how a lot of those companies kind of get monetized from one firm to another or to a new owner to pay back those investors. In my comment a few minutes ago about the leveraged loan market not seeing the deal flow, that's part of that process, is that those deals get brought in the form of bank debt, high yield bonds, and that market right now is just really shut down. I think there's one deal that launched this morning, but that's been it over the last few weeks. So I think that's got to be something that needs to be watched, and certainly paid attention to as we go forward. And layering that into the private credit, my view there is that the story on private credit is that these are managers who are willing to own the company through a cycle, and they're loan transactions that might have one, two, three, four lenders involved, and therefore the company come across difficult times. The negotiation process is easier. They can do more things together as a group to help these companies out and get through the cycle. I don't know that anyone was predicting this was going to be the issue as far as a new day on tariffs. So I think there is some potential runway there. It's just what's the tolerance of some of these private credit shops as they, potentially have to modify credit agreements, do amendments for companies, potentially look at PIK interest, foregoing that's foregoing interest, cash interest in the current term and adding that balance to the loan balance. So there are things they can do, but then there comes the question of valuation on a lot of those underlying credits and how that potentially gets reflected in the funds that actually own the companies. And they aren't as liquid as the broadly syndicated market for the reasons we just talked about. Fewer owners, they don't trade around as much. So that's a big question to me, is just the valuation on some of these credits going forward, and then how much leeway and tolerance some of these private credit shops are going to have in working with these lenders, depending upon how long this goes.
Tony, I want to get your thoughts in a second, but I want to just unpack one thing that Blaine mentioned, because I was trying to look for the source of it, but I couldn't quite find it. But I know I had just read that that the payment in kind had gone up considerably in the private credit market of note, and it makes me flash back to 2005 through 2007, when all of a sudden payment in kind became,
Exactly.
it was all good until it wasn't good, and then it
Yeah.
became anything that had a pick attached to it was quite negative. And so, is there reason to think that this is going to be somewhat benign, or is there reason to think that the fact that private credit markets are starting to put in more payment in kind is maybe a canary in the coal mine? That here we're looking at largely a lot of the think these private credit loans tend to be around 3 years ish in duration, and I think we're kind of coming into like maybe the first wave here in 2025, 2026 of a big wall of private credit that needs to be rolled over.
Yeah.
Perhaps they want to own it for a cycle, but they probably were expecting rates to be a fair bit lower at this point too. And so now we're getting maybe some pick in order to allow these firms that don't have necessarily the cash flow to support the debt. Is this a risk factor, or am I just being too bearish here, Blaine?
No,
Well,
I don't think you're being too bearish at all. I think it is something that certainly should be watched, and probably as a percentage of the entire loan portfolio, to the extent that that gets reported. I think the rating agencies, I would think that that's something they're going to be watching. Just, the how much of the portfolio do you have, PIK attributed to versus
Yeah.
cash interest, and as that grows, I think that's a risk factor. And I think, these companies they're gonna, they're gonna suffer. Maybe that's the wrong word, but they have the same challenges that a public company does, right? In forecasting um, their business, in today's environment, and their capital needs. And you throw on top of that fact that they're levered. And I mentioned last podcast that some of these companies are, if you've seen these deal books, they get levered to a certain number, and it's, that's perfection. And you throw what we're dealing with now, and so they have the benefit of having owners, these private credit shops, who probably do have more tools in their toolbox to help them, but they still suffer from some of the same concerns that public companies are going to be suffering from. So
For sure.
I
And
oh,
Tony,
yeah.
one of the things, and we know because we're on the front lines talking to students every day, right? We there's a big expectation that the investment banks are going to be back, because we're going to see a big IPO calendar, maybe a big M&A calendar. Private
Yes.
equity firms were hiring aggressively. Investment banks and private equity firms maybe dialing back the hiring a little bit here, which maybe again is a little on the early signs of where things are slowing down. So what are your thoughts on the fact that we've seen kind of a lack of issuance and maybe lack of liquidity, and maybe some increased risks?
Yes, so if we actually really think back about the root of the overall thing, apparently it starts with the uncertainty of the current the administration policy, and also this is to a bigger issue is about the independence of the central bank, Federal Reserve in this context, right over here. So we saw the two uncertainty. Now, whether this uncertainty is some can be resolved within a short amount of time, that's definitely are going to have a huge impact over the asset pricing, including both public market and the private credit market. Once we actually get to the June, I think that U.S. Would have we see roughly about 6.5 or 6 trillions of the debt mature. So in this case, that apparently we need to renew the 6 trillion, almost like a national debt by the government. Now the question is how much at what cost, right? This now here on one side, apparently from the President Trump perspective, we need a low interest rate because from his point of view, that we have seen the price, food price coming down, we have seen the gas price coming down, we have seen the stock market actually coming down as well. So everything actually supported his view that we should have a low interest rate. But on the job market point of view, this is Rich, you mentioned about the bank, but from the job market point of view, we saw a very great number just actually released for the jobless claim and for last month and even last 2 weeks. That actually is showing that we have still seen a very resilient labor market here that apparently give enough um, reason for Federal to Reserve to take their currently wait and see stance over the market. Now here we definitely see this kind of a two ongoing development drivers, economic driver and financial variation driver over there. Now we also approaching to the June. If we actually U.S. default about the interest payment, which no one actually would anticipate, if that actually happened, that there would not be any risk-free rate in the U.S. or the whole financial system will need to be redefined. So this is something that unprecedented. No one has actually experienced this like before. Given that into the consideration, maybe taking a very cautious approach at this moment for anyone, institution or retail investor, I think this is definitely would be a good choice. So you could be right. You try the bottom fishing, could be right here, but this is definitely with some kind of a risk. We know that's a big risk factor and some probably unprecedented risk factors going on here. Rich.
Yeah, you talked about rates, FOMC, and the Fed's dual mandate, and I'm putting up another chart here. I kind of stole this one from Francois Trahan. I saw it on LinkedIn, and he showed the difference between the unemployment rate and CPI, which I have here on the blue line, and plotted that versus the yield curve, and the yield curve, as we know, matters because that matters for the bank's margins, and it matters, for the bank's willingness to want to make loans. As that yield curve is steepening, banks are going to feel more willing to want to make loans, et cetera. And maybe the banks and changing the SLR could be a way to help Main Street more so than Wall Street, as Treasury Secretary Bessent wants to talk about, doing that instead of the QE. But I think to your point, Tony, this chart to me kind of shows a little bit of the difficulty of the Fed right now, and I know this is a lot of the debate between the Hawks and the Doves about what should take precedence. Should it be the unemployment rate or should it be the CPI?
Yes.
Whereas the Doves say that there should be some cuts, the preemptive cuts, just in case the economy gets bad. Whereas the Hawks are saying inflation is far from under control right now, and unemployment right now is really not that bad, even though there are some signs that it could get worse.
Yes.
So it's better to be patient, and that's clearly where Jay Powell is right now, though the bond market is probably more in the camp where we need to see more cuts. And we saw that difference of opinion on the dot plots that came out in March. So I think there's going to be some further expectation in the coming weeks before the next FOMC meeting that the Fed is going to continue to try to clarify how this disconnect between the FOMC stance and the bond market stance. Just wondering, Blaine, your thoughts on how bond investors, fixed income investors, credit investors are trying to navigate the difference of opinions on what's going to go on in rates markets, and where that might be, how that might be changing the shape of the curve.
Yeah, I wanted to add one point, the way I think about it as well. Just because I do agree that the Fed is in a bit of a predicament, and what they do, if you just listen to Fed Chairman Powell the last couple of times, he's said that. There's inflation, controlling inflation, and then I think they're concerned about inflation expectations and keeping those anchored. And I think if you're the Fed, you probably you you want to take this wait and see approach, because they probably don't feel like a lot of this information has flowed through the data yet. The jobs data. Have we really seen the impacts to jobs yet from this overlaying tariff policy? And will that start to roll through, and then that chart you just had up might look a little different. So I think for them, they might think it behooves them to wait just a little bit to get more data, because they have the inflation target at 2%, but if they lose that inflation expectation from the populace, the consumer, that's a much bigger issue.
And as you're talking, I agree with you, and I think St. Louis Fed president, and I'm forgetting his name, highlighted that in a period of stagflation, he felt that inflation expectations were a much more important indicator when you have this kind of conflict between what's going to happen with growth versus what's going to happen with inflation. And he pointed to inflation expectations, and Chair Powell also, as you said, pointed out inflation expectations. And I just brought up the University of Michigan consumer expectation in inflation in the next year, and we can see that in 2024, from May, is a little above 3% in May and June, and then by December had fallen to like 2.6% and looked like it was on pace to kind of move back towards the Fed's 2% target. And here in 2025, it's jumped from 2.6% to 6.7%, which if I widen that out, I think that's like the largest jump we've seen in history. And so consumers right there, at least in this particular survey, and I know everyone wants to talk about soft data versus hard data, but in this particular survey, when you see a move of that magnitude in such a short period of time, I think people are sending a pretty clear message that inflation is still a big concern to them, and they don't see anything that's happening that's going to move in the right direction. In fact, it's moving decidedly in the wrong direction. Tony, I want to get to you, but I want to get Blaine's thoughts on that first.
Yes,
Yeah, no,
yeah.
I think as you widen this chart out too, Rich, I think what's really interesting, if you look at that kind of 2020, 2024 period, that middle of that chart, we were on a pretty strong downward trajectory. I mean,
Yeah.
there were obviously some big movements in there. If you highlighted those, they would look really nasty. But the trend was down, as you said, to that 2%, and then to see it reverse like this, I think this is what the Fed is they're looking at other things, but this would be something that would say we need to take time here before we making irrational movements, just given the uncertainty of we haven't been in this type of a situation before, quite frankly. And
We
so
haven't.
we're dealing with imperfect information, which is what we're always dealing with, and you're dealing with a little bit of imperfect policy, and for them to take all the rhetoric they're getting, which is a lot, but just to hit the pause button here for a little bit before they do something, because I think looking at something like this, certainly would behoove that. And then also, I think the leading indicators numbers this morning came in much more negative than expected too. So I think, again, another kind of sentiment number that's out there that's coming in weaker, and I think it has been weaker over time. The last several indicators on that number. So all this, I think, leads to the fact that if you just listen to what Fed Chairman Powell is saying, and he's gonna take his time here, I think that's what they're gonna do.
Yeah, for sure. And while this U of M number is one that we can observe in the markets, the Fed's going to have their own data on
Yeah.
inflation expectations on a district by district basis. And so clearly this is, maybe directionally correct, even if magnitude's not correct. I think, Tony, what are your thoughts? This sends a pretty strong message to me that the Fed is in a wait and see pause mode, and I'm always tend to be a little bit more leaning towards the Fed's not going to cut rates as much as the market thinks. But what are your thoughts on that?
Yeah, I definitely agree with both of you. Like a feeling that as what I actually just mentioned, the Federal Reserve does actually have some legitimate reason to take the wait and see approach. But any this kind of a huge surprising move in this particular case, that's actually telling us a couple things. It's like apparently both consumers like would actually weigh in their uncertainty of their future earning or future spending that will be translated into the company's revenue and earning perspective. Whenever they see this kind of price high, the next question is whether the company, especially the domestic company or multinational based like company like Apple, they will be able to pass through the hiking costs through the tariff into the end product price for the bear by the consumer. And apparently, we know that the consumer will not be able to just absorb all of the hike in the cost through the tariff or through other things. Now, the company definitely need to absorb some of the cost or hike through the tariff, certainly for sure. In the past, like the cost mainly will be split pretty much evenly by the manufacturer, the supplier, and also by some of the importer here in the U.S. or what a sense we call it multinational companies. Like taking Apple, for instance, like having the phone, iPhone manufacturing and assembly and put it on in China and then actually ship overseas here and import over here. So if you actually put a high tariff, 100% or 130%, even though the company might be able to absorb maybe a certain part of that. And in the past, it was any hike within the tariff, like 10%, 20%, it would be split roughly evenly between the company and the manufacturing companies up in the supply chain. So, but now here with such a huge hike in the tariff, no one knows. Even as what Chairman Powell had mentioned, the current scenario is way beyond the scenario analysis by the central bank when talking about the tariff, right? They didn't anticipate it could go such a high rate. Now, in this case, definitely, I would anticipate there will be no trade between mainly the China and the U.S., and we are going to see the higher price, definitely high price for a short amount of time. And any supply chain here, could be a short time frame, because whenever we see a huge hike within the end product price, we're going to see the even faster shrink over the consumption if those products are elastic product like iPhone and so on. We are going to see the demand shrink significantly. That translate into much lower revenue earning per share for company. And typically, it's maybe a leading cause of unemployment and recession. This is kind of a downward economic spiral. What happened? This is quite mimic to what in the past what happened in 1930. Whether we are going to get into that really depends on whether President Trump or Trump administration will be able to set up a trade deal with major, I think, the supplier, the China, in this sense, over the next 60 or 90 days. Apparently, the sooner, the better, because that would give a very clear, they maybe take away the uncertainty over the tariff and taking away the uncertainty over the fiscal policy and financial policy. Apparently, keep that in mind. Once we actually get into June, 2 months from now on, that we have a 6 trillion like a national debt mature. This is not also a major issue that the current administration has to need to deal with. And so that's my interpretation. So I do not anticipate this such kind of expectation would say they're quite high, because eventually when it reaches that point, it's going to reverse quickly due to other unforeseen issue like a great financial crisis or recession. This is something no one actually want to see that.
Yeah, a few things you mentioned there. I wanted to kind of touch on here, and I have a chart up now of looking at I'm looking at dollar yen FX rate versus this interest rate differential between treasuries and JGBs. I just chose the 10-year here, and this I happen to pick this particular currency pair, but if you brought this up with every major currency pair, you would see exactly the same thing. Bring it up bonds versus bunds and euros. Bring it up bonds versus gilts and the sterling. Bring it up bonds versus Canadian bonds and dollar Canada pair. Whatever one you want. What it shows you is that you would expect the dollar to be much higher based on interest rate differentials, a spread that has normally kind of can disconnect at times, but tends to not stay disconnected for too long. However, we've seen material dollar weakness relative to those rate differentials. Kind of going back to what we talked about this at the start of this podcast, and I want to end it here. Talking about how investors fleeing the U.S. and then pulling their dollars back home wherever that happens to be, but also knowing that a weaker currency, as we've seen in emerging markets before, and the U.S. is certainly acting like an emerging market at this point. A weaker currency means higher inflation, and so to your point, Tony, about how historically we've seen the suppliers, et cetera, maybe eating a lot of those kind of cost inputs. I don't know. It's not entirely clear that they're even going to be able to do it at this point. And this weaker currency may lead to higher inflation and therefore keep the Fed on pause, which may mean that higher for longer rates, which may mean more weakness in the loan market and private credit. It's all kind of weaving through everything that we were talking about today. So maybe Tony, in the interest of time, just give me your last couple thoughts on this, and Blaine, I'll give you the last word then.
Yes. To conclude, that we have seen the unprecedented uncertainty over the financial market right now, both public and private, and definitely for institutional investors and retail investors, might be the perfect time to stay vigilant, Rich. I think taking a cautious approach and moving across into the summer might be the best approach to go.
Blaine, what are your thoughts on what we're seeing here in the markets?
Yeah, so I would just echo a little bit about what Tony was just saying, and that to me it really comes down to where the tariff policy is going to actually be. And I know we're in this 90-day period of uncertainty, but it sounds like there's some negotiations going on. But to the extent that we get tariffs, whatever those levels are they a one-time hit to the price level, or are there some secondary effects that people have been reading about? And if those secondary effects continue to happen, as you're mentioning, the weakening dollar is kind of inflationary. It gets back to what we were talking about a few minutes ago, and about just the Fed's going to want to battle to make sure they keep inflation expectations anchored, because I think that's a much harder thing to rein in if they become quote unquote unanchored. So I think it's going to depend a lot on the effects. The primary effect of the tariff will be a price movement, and then what are the magnitudes of those secondary effects as we kind of get the ripple effects through our economy that I'll be watching. So.
Yeah, that's a great point, and that's a good place to end it. Blaine, that inflation is a mindset, not so much a number, right? It's how it impacts consumer behavior. The same way bull and bear markets are a mindset more so than a number, and maybe we're in that bear market mindset right now for a lot of assets. So on that, we'll leave it on this edition of Macro Matters. Thank you to you, Blaine, for joining us again, and thank you, Tony, for joining as always.
Yeah, thank you, Rich. Thank you, Blaine, and look forward to our next discussion.
Yeah.
Looking forward. Thanks, everybody.
Thank you.